Welcome back to The Explainer. In our last one, you learned the GDP equation and its two policy levers. Now, if you've ever wondered why the stock market suddenly drops when a central bank makes a seemingly tiny adjustment to interest rates, you are in the exact right place. Today, we are going to unpack exactly what happens when the Federal Reserve actually pulls the monetary lever. We're going to map out an entire chain reaction, step by step, so you can see how a single policy decision ripples through the whole economy, creating a sequence you can actually trade against months before it's even finished.
Okay, let's dive right into this. You remember the formula, right? Gross domestic product equals consumption, plus investment, plus government spending, plus net exports. Now, 70 cents of every single dollar in the U.S. economy comes straight from that C, consumer spending. And today, we are zeroing in on the most powerful lever the government uses to steer that spending. We're talking about the Federal Reserve.
Section 1. Monetary versus fiscal policy. Before we get into the Fed's actual playbook, we really need to look at the two massive levers used to steer the economy. So think of monetary policy as a highly agile speedboat. It's controlled by the Federal Reserve, it runs on interest rates, and it is incredibly fast. It's easily reversible, making it absolutely perfect for fine-tuning the economy to fight off inflation or maybe a minor recession. But it does have a major catch. You can't push on a string. What that means is if we're in a deep, fearful recession, the Fed can drop rates to zero all they want. But if consumers and businesses are just too scared to borrow, well, that cheap money doesn't do a thing. Now, on the flip side, fiscal policy is your massive cargo ship. It's controlled by the government through tax cuts and public spending. It is fantastic for deep recessions because it blasts powerful, direct stimulus right into demand. The downside? Man, it is painfully slow to pass through legislation, it creates budget deficits, and honestly, it can even crowd out private investment since the government is out there competing for the exact same pool of capital. But because monetary policy is just so fast and far-reaching, the absolute golden rule for this entire explainer is simply this: don't fight the Fed.
Section 2. The Fed Chain Reaction.
Let's move to and see exactly how this builds. When the Fed decides to make a move, it kicks off a physical, highly predictable domino effect. Let's walk through this 6-step chain reaction, domino by domino. Step 1. The Fed raises interest rates to cool down an overheating economy. Step 2. Almost instantly, mortgage rates shoot up. Borrowing gets expensive, fast. Step 3. Because those mortgages are suddenly so pricey, new home sales drop. And hey, when people aren't buying new houses, the demand for things like washing machines, refrigerators, and new carpeting just completely falls off a cliff. Step 4. The manufacturers making those appliances and home goods watch their orders dry up, so what happens? They have to start issuing layoffs. Step 5. Now you've got more people out of work and everyone else is feeling the squeeze of those higher borrowing costs, so overall consumer spending, that massive C in our GDP equation, takes a really severe hit. Step 6. Finally, with corporate earnings dropping across the board, the stock market corrects. So why does this matter to you as a focused learner? Because every single link in this chain is a tradable signal. This chain reaction starts the exact second the Fed moves, meaning you can position your portfolio months before the word layoffs ever makes it to a mainstream headline.
And this brilliantly illustrates that we aren't just talking about abstract textbook theory here. Let's look at real numbers. Between 2022 and 2023, the Fed was fighting soaring inflation, right? So they hiked their benchmark rate from basically near zero to over 5%. And the immediate ripple effect was undeniable. 30-year mortgage rates roughly doubled, jumping from around 3% to over 7%. New home sales cooled off instantly. And if you were paying attention, home builder stocks and consumer discretionary stocks started underperforming the broader market well before any official recession warnings hit. I mean, way before the actual word recession was even being thrown around by the news. This proves that the Fed's actions create a reliable calendar of events that you can actually position against. It is pure cause and effect, playing out right in front of us in real time.
Section 3. Trading the rate cut. Now that we've seen how a rate hike just crushes demand, let's look at what happens when the Fed flips the switch and stimulates the economy by reversing the engine. And honestly, this highlights a huge trap that almost all beginners fall into. When the Fed cuts rates, amateurs just assume, oh, all stocks benefit equally and immediately. So let's test this out. The Federal Reserve just announced a 0.5% rate cut. If you had to anticipate the market's reaction, which sectors do you think will react first and most aggressively? Is it consumer staples, the companies making everyday household items? Or is it home builders, auto manufacturers, and financial institutions?
If you said home builders, autos, and financials, you nailed it. They react first. That specific trio is incredibly rate sensitive, and the reason is simple. Their entire business models run on borrowing costs. Think about it. When a consumer buys a house or a car, they aren't usually handing over a briefcase of cash, right? They're financing it. So when rates drop, those massive purchases suddenly become affordable again and demand just skyrockets. And financials? They benefit because loan origination goes through the roof. On the flip side, consumer staples barely even flinch at a rate cut. People buy toothpaste and groceries with their weekly cash flow, not with a 30-year line of credit. Lowering interest rates isn't going to make someone suddenly go out and buy 3 tubes of toothpaste instead of 1. Understanding this exact distinction is really what separates an amateur guessing game from targeted big-picture analysis.
So, you now possess a totally actionable framework for reading the macroeconomic tide. Let's do a quick rundown of the main takeaways from today's explainer. First, our golden rule: don't fight the Fed, period. When they move, the market moves. Second, know your levers. Monetary policy is your fast, reversible speedboat, while fiscal policy is that slow, heavy cargo ship. Third, respect the chain reaction. A single rate hike tips off a totally predictable sequence, from mortgages to appliances to layoffs and finally to the broader market. And lastly, track the right sectors. You now know exactly which rate-sensitive industries will get hit or helped first, and you'll know it long before the news anchors even start talking about it. So, before this explainer, you knew the GDP equation. Now you know the Federal Reserve's entire playbook and exactly what happens when they pull the levers. But what if you knew exactly when to look for the economic data that confirms their next move? What if there was a specific calendar that told you the exact days of the month these vital clues actually drop? In our next explainer, we are going to build that exact macro calendar. We'll separate the leading indicators that tell you the future from the lagging indicators that only confirm the past. It's going to be a real game changer, so stay focused, and I will see you in the next explainer.